former Fed Governor Randall Kroszner weighing in on the challenges facing the Fed in the face of rising prices. Here's what he had to say.
The question is what's going to happen going forward? Is this kind of a one-time adjustment that we made up for lost time, output, and demand, and so prices have moved to a new level? Will they just kind of stay along there, or are they going to continue to rise? That's the challenge that the Fed has, and that's all about managing the expectations of what's coming next.
Joining us now, David Leibovitz of J.P. Morgan Asset Management, Emily Rowland of John Hancock Investment Management, and Michael Schumacher of Wells Fargo Securities. A phenomenal panel. Thank you all so much for being with us. David, I want to start with you. And really, some of the push-pull here relies on what's the potential biggest policy error for the Fed, moving too quickly or moving too late. And right now, they have been saying it is too quickly. That is the biggest risk. Do you disagree as you look at the data?
I don't disagree. I think that, Mike made a very good point just now that there's a pretty significant difference between tapering and tightening. And so, what I think the concern, at least from where we sit, is the economic data has been coming in a little bit softer than expected. The inflation data may have peaked for the time being, but it's certainly been running a bit hotter than people think. I think that the market has this view that the Fed is more focused on inflation as opposed to the real growth story and the labor market story. But actually what the Fed has told us is that they're thinking about it in the complete opposite way. And so, with labor market improvement until this most recent month, a little bit slower than people were thinking. Obviously, the economic growth numbers not reflecting the big surge in activity that a lot of folks had penciled in for the back half of this year. I think that, the risk here is that the Fed moves too quickly. But one of the things that we learned from the Fed during the prior cycle, and I do think that this is going to repeat itself, is that they're going to err on the side of caution. This is a Fed that's going to measure twice and cut once. And so, again, the risk is that they move too soon, but we don't necessarily think that that's the way things are going to end up playing out.
Emily, how do supply chain disruptions fit into this, and how, given the fact that they are pressuring prices upward?
Yeah, this is an important consideration right now. And what we're seeing is that these supply chain constraints, and Lisa, you tweeted about this morning, are extending this challenge in terms of inflation being potentially a little bit more sticky than we imagined. So that certainly puts the Fed in a difficult position as they are seeing these inflationary pressures perhaps not being as transitory as expected. But at the same time, we're moving ever closer to their goals with the jobs market continuing to heal. And with that, again, that string of good data as it relates to jobs, as it relates to the rest of the economic picture here in the U.S. So certainly a challenge. We agree with David that we think that they'll be patient. The problem is that right now the Fed is in fifth gear. They're implementing warlike policy. Their balance sheets doubled since the pandemic, and you're not really supposed to stay in fifth gear for all that long. So we do see the Fed shifting down into fourth gear, announcing potentially tapering in September, starting that with the tapering of about $10 billion in purchases per month in 2022, and slowly shifting down as they get to more normalized levels in the next year.
Michael, here's what I'm struggling with. I'm looking at a market that people say reflects a very strong economy. They see this economy lasting longer because the Fed is not going to act too soon, and yet the yield curve just won't steepen. Why is that? Should the yield curve be a lot steeper right now where we are based on the Fed's lack of movement in the face of inflation?
Yeah, Lisa, it probably should be steeper. And we've made this case for a while, and it's been stubborn. I certainly agree with that point. The market's taking its cues from the Fed. That's pretty clear. The market's waiting for tapering. It's waiting for a hint. Is it going to get it from Jay Powell this week? We doubt it. But eventually, sooner or later, the Fed will get around to tapering. And at that point, we think yields back up fairly significantly. So yes, yields are awfully depressed, probably too much so, but market's really waiting on the Fed at this point.
And just quickly, Mike, to follow up, do you think that the Fed responds if there is a backup in rates?
Probably not in the near term. And I think the Fed's got a fair amount of latitude here. So consider the 10-year Treasury, 135 plus or minus. It was 175 back in March. The Fed didn't seem terribly spooked. In fact, Jay Powell referred to that as a vote of confidence in the U.S. economy's eventual recovery. So If the 10-year were to go to 160, 170, 180, would the Fed be terribly worried? I doubt it. If it went to 2+, frankly, I'd be shocked. But would the Fed respond then? Yes, probably so.
In the meantime, we continue to get data. Which data matters continues to be a question. U.S. GDP and personal consumption figures coming in just shy of estimates. For more, let's go to Bloomberg's Abigail Doolittle. Abigail.
Well, Lisa, certainly a lot of data this morning, a big data dump, in fact. However, to your point, what matters? In fact, markets not reacting all that much. Now, all of the data coming in this morning, just a little bit soft. Initial jobless claims a little bit higher than the estimate, a little bit higher than last week. The same deal with continuing claims, a little bit above the survey, a little bit higher than last week. As for 2Q GDP, it's amazing because up 6.6% on a historic basis. That is extraordinary. Slightly off the survey, though, better than the first quarter, though. And for personal consumption, a similar situation, up 11.9%, a little bit softer than the survey, but better than the first quarter. Overall, not a lot of reaction from markets, but where we are seeing a big reaction, not surprisingly, the 10-year yield backing up right now, up about 3 basis points. Not so much on the data, Lisa, but as you know, we do have this Fed talk out this morning between Esther George along with Bullard, both saying it's time to taper. So we see this backup in yields. That 10-year yield at 1.37%. As for the data and markets, the S&P 500, we have had record high after record high, this summer melt up, even as the surprise index for economic data continues to go down. In other words, Lisa, that negative correlation between stocks and the economic surprise. Bad news is good news, at least for stocks, Lisa.
Yeah, Abigail, thank you so much. And bad news is good news for stocks, especially because rates have remained so low. And I want Emily and David, I would love for your comments on what Michael was just talking about. This idea that the yield curve should be steeper in his mind, especially given some of the data coming out and the strength. I mean, Emily, do you agree? Is this something that really is that dissonance with the rest of the economy and something that will right itself in the near future?
Listen, the 10-year Treasury yield has basically been in a 40-year decline. And we see these sort of temporary backups reflected by things like better growth expectations. But there are some longer-term, really key elements here that we expect to reassert themselves as we get through this transitory inflationary period. Things like demographics, things like technology advancements are wildly disinflationary. So we actually see this downward trend in the 10-year Treasury continuing. That creates a problem, again, for the Fed. As the yield curve flattens, the Fed's going to have a really hard time raising rates and risking inverting the yield curve. So we actually think that we're going to be in a continued period of low rates, which has a lot of cross-asset implications that we can discuss.
David, what do you think about the assertion that Michael is making that basically when the Fed announces tapering, the long end will move higher? This has been a controversial point.
I would agree with what Michael was saying. And the other point I would make here is that I effectively take no signal from the level of rates at this point. I think when you have G4 central banks coordinated in their asset purchase programs, really difficult to explain or figure out what 1.36 on the 10-year actually means. And so I'm much more focused on the direction that rates are moving in. And I do think, given the state of the economy, given the outlook for corporate profits, that rates are generally sitting a bit too low. And so we very much expect steepening into the end of the year as well. And we think that will coincide with a revival in the more cyclical reflationary trade across the global equity market.
David, how much of a yield increase can stock markets tolerate?
So it's interesting. We've spent a lot of time on this issue, and historically, the magic number on the 10-year has been around 4.5%. So effectively, rates and equities could move higher together until the 10-year hit 4.5%. That relationship did break down after the financial crisis. We put the magic number somewhere closer to 3% in the current environment. And so, in a vacuum, rates can move higher before they cause indigestion in the equity market, but the speed with which they move is equally important. And part of what was so challenging at the beginning of the year, part of what caused so much volatility back in February and March, was that you were seeing these 2 standard deviation moves in the Treasury market over the course of a given week. Risk assets can't handle that, but risk assets can certainly handle rates that are higher than current levels.
All right, everyone's sticking with us. Right now, let's get a check on those stocks, in particular those moving ahead of the opening bell. Here is Katie Greifeld. Katie.